Friday, October 18th, 2019, Maneco 64, home of alternative economics and contrarian views. So the IMF is worried about world growth. They're talking now about synchronized slowdown. They always overestimate growth, right? A few years ago, they were cheerleading about synchronized growth, and it was like nowhere to be seen, really. So I would say they're underestimating the slowdown as well. We've had Chinese GDP come out this morning, lower than expected, the lowest level in 30 years. And I'm going to talk about GDP as well. I've spoken about this in the past, how GDP is calculated and how actually the US and Chinese GDP are anemic if you look at government spending. And I'll come to that in a minute. IMF is also comically warning about the risks of low interest rates, the fact that it could create risks for investors in the markets. My analogy for this is like Don Corleone or Vito Corleone from The Godfather warning the general public that violence could erupt in the community for some reason. It's like warning the public about what they're gonna do, what they have done. Right? This is the economic mafia boss of the world who's pushed all the major countries, major central banks to keep cutting rates, to keep rates low. Even Lagarde, who's the she's outgoing member already. She's going to be ECB president in a few days. She is she's talked about how great negative interest rates are, right? And now they're warning, of course, that it could cause instability in the markets. Well, of course it could. Why I think it's causing instability in the market? Well, because the low artificial rates are created by the central bankers. They're manipulated. How do they do that? Well, they create credit out of thin air. With those credit entries, they go out into the market and buy fairly safe assets like treasuries, mortgage-backed securities, agency bonds, right? Same thing in Europe with the ECB or with the Bank of England. They buy all these assets which in the past have been bought by pension funds and investors to have a decent return of 5, 6, or 7%, right? For retirees, for trusts or whatever, right? For charities, for funds. But now the central banks are crowding out the safe investments. And what does that do? Well, the effect that has is that it pushes investors and other people to go for riskier assets. So central bankers and bureaucrats, like in the IMF and governments, they never think of the consequences of their actions. They just want to go they just want to have the policy objective of low rates because they think that will increase economic growth. But it has really bad effects, as you can see. Now, Don Corleone or the IMF is warning that there will be instability, right? So it's a joke. They're just trying to cover themselves because they know things are going to get bad and they're going to hit the fan, right? So let's look at Chinese GDP first. This has come out overnight. So FT reports China's GDP growth sinks to new low of 6%, right? So China's economy expanded at its slowest pace in about 30 years at 6% in the third quarter of 2019 compared with a year earlier, delivering another blow to global growth. According to figures released by the National Bureau of Statistics on Friday, the country's trade war with the US and cooling manufacturing and investment sentiment took a toll on the world's second largest economy. So there you go. We've also had, before I go into the GDP, talk about GDP and the fact that it actually is not a really great indicator of the health of the economy. I'll look at some of the economic data we've had this week. because it's not just China that's slowing down. We had, of course, in the US on Wednesday, we had the retail sales data. They came out at minus 0.3, was expected up 0.3, so a lot worse than expected. So yesterday as well, we had some US numbers. We had building permits drop 2.7%. We had housing starts drop 9.4%. Jobless claims were higher than expected, 214,000. They were expected 212. The Philly Fed index, which is closely watched by markets and investors, that came out at 5.6, was expected 7.3, dropped from 12, right? So what about industrial production came out yesterday in the US as well, minus 0.4. It's expected minus 0.1. So it's not just China that's slowing down, the US is slowing down. The problem for the US and China though, and they are the biggest economies in the world, they drive the world economy, right? The problem with them is that they are drowning in debt, both of them, not just China. And deficits, of course. To drown in debt, you need to run deficits. And I've got here economic and financial indicators, the latest from The Economist, right? And if you look at the budget balance, US, they say 4.7% deficit they're running. China, 4.5. I would say the US number is almost more like 6% now. We've seen that the US Treasury borrowed, ran 1.2 trillion in new debt in the last fiscal year. So they're both running really big deficits. They're running deficits that you usually run in a time of crisis, like in '08, where you have to, well, not have to, I don't agree with it, but it's the Keynesian philosophy that the government has to step in to buffer the slowdown, right? So they're running already these huge deficits when everything is supposed to be doing well. So that's the problem, you see. That's the problem right now. So when things really deteriorate like they look like they're doing right now, they won't have any ammunition, right? So let's go to GDP, because the way they calculate GDP, as you can see here, GDP is Y equals, so it's the sum of consumption, right? Consumer spending, consumption. We know that in the US, that's almost, well, that's about 2/3 of the economy. And we're seeing through retail sales and other data that the consumer is like slowing down, right? Plus investment, plus government spending. That's the key part there. Government spending plus X minus M, so and net exports, right? So the US is actually running a deficit also in trade, right? So that takes away from GDP. But one thing I would say, government spending, right? How does government spend? Well, they first need to tax the private economy, right? And then they spend. They go back and they spend in another part of the economy. So they hurt Paul to help Peter, right? So it makes no sense whatsoever, government spending. Well, for me it doesn't, because I'm a proponent of very tiny, small government. The problem with this, though, is that as you heard earlier, US and China are running like 5% budget deficits, which means that the government is spending 5% more than they actually take in terms of the GDP. So, and that's not good, because that means you're adding debt. So if you actually take that away from the GDP calculation, because the real health of the economy should be measured by organic private sector growth, in my opinion. And I think anyone would agree to that. Looking at the GDP, the economist here is saying that the US is forecast to have a 2.2% GDP growth. But if you take that 5% extra that the government is injecting into GDP, you can see that the U.S. is actually has negative private GDP of about 2.8%. And you can do the same thing for China. Right now we're at 6%. If you say they're running a 5% budget deficit, China's only growing by 1%. And these two countries are adding and adding to the debt mountain or the debt pile. What's happening now, and I think that's why the IMF and everyone else, central banks, are very concerned, is because the marginal utility of that debt is really almost down to zero. And what does that mean? That means that the extra debt they're creating in the system through their monetary policy, and now the IMF is also pushing for fiscal policy. They want the governments to increase the deficit. That's having no effect on growth, and that's not a good thing, because it means that they won't be able to grow the economy faster than the debt grows, and that's a bad thing. That will lead to an implosion of the system, and that's why they can't raise interest rates either. So they're in a real corner. They're cornered rats, these people, and I think it's going to get worse. So not great news from China. I don't think things are going to get better. Not great news from the U.S. as well. The only thing the U.S. and China are doing really well is creating a lot of debt. But it's, as you've seen, it's having really very little impact on their growth prospects, and that's what they worry about. That's what they call deflation, even though it's a misnomer, right? Because we know the cost of living is going up. What they mean by deflation is that their Ponzi scheme, fiat currency debt credit bubble is on its last legs, because we're getting no growth anymore. And one of the reasons for that is the low interest rates, especially when you think of the demographics. When in the West, a lot of people baby boomers are retiring. If they had, they could get 6% on their nest egg, they would be spending a lot more, wouldn't they? But the thing is as well, their assets wouldn't be worth as much, because by keeping interest rates low, we've seen a bubble in all the paper assets. So there you go. GDP slowing down, coming to a screeching halt in China and in the US. And you can be sure that these countries are going to start spending. They're going to listen to the IMF, and even central banks now are telling that governments need to do fiscal policy, augment fiscal policy. But it's only going to make it worse. It's only going to grow the debt pile. It's only going to incentivize central banks to keep interest rates low. So it's just an insane policy that's going to make things even worse. So you don't want to be in this system. Try to be in it as little as possible, as I've said before. So now let's look at the markets, see what they're doing this morning. It's just before 8 a.m. London. We've got spot gold, $14.90. It's down about $1.50. Range has been $14.89 to $14.95. So I guess we can safely say here that gold is going nowhere for now. It's consolidating, which is not a bad thing. Looking at the charts, it looks like we're forming a bull flag. We'll have to see. We just have to be patient. Silver is down 5. Silver did well yesterday. I think we got up to 1765 or thereabouts. Right now we're at 1749. Range has been 1748 to 1759. The Dow is down 35 points. Dow futures down just 0.1%. S&P is down 4 at 29.94, down 0.13%. NASDAQ 100 future is down 1/4 at 79.24. The pound is down 0.2 at 128.60. And the euro is at 111.18. That's unchanged. The euro has picked up a bit lately. We had seen the 109 handle in the euro versus the dollar. a few weeks ago or so. Dollar is unchanged against the Japanese yen, 108.58. The dollar is up slightly against the yuan at 708.56. WTI crude, we've seen crude oil move up a little bit the last day or so, is at 54. It's unchanged. And Brent is almost back up to 60. It's at 59.50. 10-year yield, 175. So it's still fairly firm, I would say, compared to a couple of weeks ago or a week ago. I think we got down to, or not even a week, a few days ago, we got down to like 165. Still very volatile, not great. 2-year yield is at 160. So bond markets are fairly quiet right now. So it looks like Don Corleone or the IMF is really cornered. So are the central banks. We've seen that the huge amount of debt, the trillions and trillions that they've created in the last 11 years out of thin air, is actually having very little impact on growth. And the problem with that is that they have to, the more debt you create in a fiat currency system, the more you need to keep creating to keep it going. The only problem is that we're not getting the growth now, so watch out. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet, make sure you share this video far and wide as well, and you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.